Good morning, Vittoria. Let's move
Morena,
straight
Anna.
over to your presentation.
Great, thank you. Good morning, everybody. So I guess I'm going to start with just some reflections over the last 12 months. And as we all know, New Zealand was enjoying pretty favourable conditions. You know, the economy was in good shape. I think the banking sector was in a good position despite the record low interest rates. And the Reserve Bank's use of monetary tools, let's say, was comparatively benign. I think it became very apparent very quickly that COVID-19 would change all of that. And I distinctly remember being on a call with a bank that was based in Italy, and they also had branches in China, and they were relaying to us in excruciating detail the impacts that this virus was having. And we really responded in the way that you would expect a bank to respond. I guess beyond the health and safety of our people and our customers, we ran a lot of scenarios, or the alphabet scenarios. So we had V-shaped, L-shaped, U-shaped, we even had a fat U-shaped scenario, W, K, you name it. I think the reality is no one really knew. And so our job was to make sure that we were running lots of scenarios and understanding the impact on particularly capital and liquidity to make sure that we were well placed to support our customers and the economy. And we created a significant provision. So we raised, and today we have a provision of around 600 million. I think the thing that really worked, particularly in the first sort of 4 months of that phase, was the way that we worked together with government and the Reserve Bank and industry. So there has been a huge combined effort from, as I said, the government, the RB, the banking sector, really working hand in glove to keep the economy moving forward. I think the government relief tools, the bank's tailored packages, and the RB obviously used virtually every monetary policy tool at its disposal. So I think the moving at that pace really required us to work extremely closely together. We didn't always agree, and neither should we, but what we did is we shared all of the insight and intel that we had so that if we needed to make some adjustments, we did and we could. And I think the Business Finance Guarantee Scheme was actually a really good example of that, where we launched that into the marketplace to support businesses. As it was initially constructed, we made some tweaks to make it more widespread in terms of its usage. So I think that's a really, as I said, a good example of that. I think the initial focus was very much on, from a banking perspective, making sure that we helped with the flow of credit. And as we all know, the banks need to really, I guess, balance carefully that objective of this flow of credit into businesses and households, but at the same time having an eye to responsible lending and making sure that it's the right decision for the long term. And so we're very confident about the support we gave our customers and are still providing our customers, which is a balance of, frankly, debt, but also in many instances helping businesses recapitalise, shore up their balance sheets and have more resilient settings. So I think when we sort of boil all of that down, the crucial thing was really that jobs were saved, and quite quickly there was initially there was a lot of fear about people losing jobs. That dissipated quite quickly, and so I think that's been the most distinguishing factor really of this recovery. And I hear it all the time from our customers. Those wage subsidies really helped give employers the confidence and the courage to retain their employees, despite the fact that they had very little idea about how this would play out. And I think the breathing room that banks provided for the lending deferrals, the lowering of the interest rates, all really played their part. And what we've seen, of course, is that we've had a really strong rebound in retail spending and housing activity, which I'll cover in a moment. But I think the reality is this level of activity can't be sustained, and we're anticipating this year to be a lot more moderate. The one other sort of stark observation is that this crisis has been very unusual compared to the global financial crisis, which we all remember was about the lack of funds to support the economy. And I think we're a very fortunate position, and we've learnt a lot since then. Banks have gone into this particular this crisis well capitalised, liquidity is strong, and so there hasn't been that same challenge. And in fact, in the first 4 months of the crisis, we supported over 35,000 of our customers with relief on around $11 billion. So that was a lot of work to get that into place, but it was quick, and I guess the availability and the pricing of capital wasn't the issue. As we stand today, you might be interested to know that about 15% of our personal and business customers are still on those arrangements. And so I think it's very important to sort of recognise that whilst the recovery in New Zealand has been really positive, we are not out of the woods, and a lot of support is still required. And we know globally borders are still an issue, vaccines are an issue, new strains are an issue, and we're seeing some double dip recessions in large parts of the global economy like Europe. So there's a lot to be proud of, but also a lot to watch out for. And so when we think about monetary policy, wow, we've seen some unprecedented changes in monetary policy action over the last year. Obviously with the OCR, I guess being cut to as close to zero as the Reserve Bank felt comfortable doing, large-scale quantitative easing to really help keep those interest rates low. We've seen great initiatives from the Reserve Bank in the Funding for Lending program, which they lend directly into the banks at very low rates for term debt. And then just recently, the Reserve Bank made a very helpful statement about it's continuing to reinforce that it will provide all of the monetary stimulus that the economy needs and will be ready to act if something happens. So I think those are really important and helpful statements. And while I very much hope it doesn't come to this, we also have an industry or a banking industry that is now ready for negative interest rates should that be required. So really the lens to this discussion that I want to bring is about how we translate monetary policy and how does that look when we think about our customers. And we all know that monetary policy is it's a blunt instrument and it's been very effective, but also creates some real challenges that I thought I would just sort of share some perspectives on. I think the first challenge really is that businesses have yet to respond. So many businesses that we talk to are more concerned with having resilient balance sheet settings, trying to get more clarity on what the outlook might be, particularly this sort of border, are we in lockdown, out of lockdown kind of environment that we're going through at the moment. And they really are taking more of a wait and see approach. And so even though there is a lot of credit available, even though the prices or the price of that credit is extremely low in comparative terms, that's not enough to really encourage businesses to really take that next step forward. So I think that's the first thing that we're really keeping an eye on. The second thing is deposits. So obviously when interest rates really fall, I mean, that's the objective of the monetary policy settings, it has a big impact on deposits. And we know that some people are very reliant on the income that they earn from those deposits. And that's been a real concern of ours, is how do we balance these objectives. And so actually just recently we increased our term deposit rates by 75 basis points to really try and give that lift for some people who are highly dependent on those income sources. Another element of deposits is that we are seeing a large balances, unusual balances, sitting in accounts that have come from two things. Firstly, lower levels of spending, and then secondly, a lot of government support. So there's around $39 billion worth of, I would say, additional deposits sitting in the system at the moment as a result of those two factors. So one of the questions we keep asking ourselves is, are those deposits stable? Will they flow out as fast as they're flowed in? So we need to be very careful about how we think about those deposits when we manage our balance sheet settings as a bank. So that's sort of a few of the deposit considerations. I think the one that we've all got our eye on is this housing market issue. And this is a well-known sort of challenge. The low interest rate environments have absolutely stimulated huge housing demand, and it makes perfect sense. the first homeowners are realising that they can afford a mortgage compared to rent because of the interest rates. A lot of homeowners are looking to scale up or buy additional holiday home properties. And then, of course, we have investors who, for a couple of reasons, A, the low interest rates, but B, when they weigh up the risk profile of different investment alternatives, they really like the land, bricks and mortar. So that's the real dynamic on the demand side. And of course, we know that New Zealand's supply side challenges have been around for decades. So we've really come to the crunch point. Last year, we decided to increase the LVRs for investors ahead of the Reserve Bank's changes to try and sort of stem a little bit of that. It didn't make enough difference. So recently we went a step further, and so we're requiring a 40% LVR for investors. To be candid with you, we have not yet seen the impact of that change either. We are really struggling with the home loan applications that remain at record volumes. So it's going to be really interesting to see this next step, which is the government adding the housing market to the mandate of the Reserve Bank. I'm really looking forward to working with the Reserve Bank on what ideas we can collectively think about for those or that additional mandate. We're talking about DTI or debt to income ratios, interest only is another point of discussion. What I'll be very focused on, though, is it needs to be orderly. The only thing worse than the current situation would be if we had an unorderly impact. So we need to be very careful when we sort of make these changes and adjustments. I guess we've also seen some great opportunities, though, also come from some of the initiatives around monetary policy and associated initiatives that the Reserve Bank's been taking. And the funding for lending program is one that is definitely worth talking about. So, the Reserve Bank is direct lending into banks at low rates for the OCR for a term period of 3 years. And I think that's given us a really exciting opportunity to think about what is the best way of distributing that of those funds. And so at ASB, we've really chosen to do that and focus in on 3 areas. Firstly, we think it's really important to support businesses who are trying to lower emissions to achieve New Zealand's overall climate objectives. Secondly, we really want to support infrastructure, particularly infrastructure development in rural or regional New Zealand. And then lastly, it's another way of supporting this housing or balancing the housing challenge by supporting the supply side dynamics of the housing market and more energy efficient, more affordable homes. So I think that's a wonderful opportunity. We want to use it really wisely to make a really long-term positive impact for New Zealand, which really brings me to another reflection, I guess, about this period is, there's more volatility than ever before. And we would like to see New Zealanders and businesses think about more resilient settings so that they can weather these challenges a little bit easier than what we've seen. And over the past 2 years, actually, we've been partnering with a leading university on a financial wellbeing framework. We use our data and we observe the behaviour, if you like, of customers and based on all of their transactions. And this framework is based on a very simple principle, I guess, of managing your everyday payments or cash flows, saving for a rainy day or events such as this, and then how you're moving towards long-term goals, whether you're a personal customer or a business. And over the last 12 months, we've seen some really interesting parts of our data. It definitely showed the reduction in spending. So we see about a reduction of 17%. And it also showed an increase in savings, these trends that I've mentioned before. And what we've seen is an aggregate around 4%. But worryingly, over the last couple of months, we're seeing some different patterns emerge from that data. We're seeing 2 things we're watching very closely. The first one is an observation around people having more difficulty making payments. And the second one for our personal customers is less customers have what we describe as a rainy day savings fund of $1,000, which is a pretty low bar. So those are the two metrics that we're watching very closely. And again, they give us an indication that it comes back to we are not out of the woods yet. We know some businesses and some people are still doing it really tough, and New Zealand still needs support to really get through this crisis. So I guess the key reflections I really have is we've got to work together. We don't have all of the answers. There was no blueprint, but working together in a very different way from the way that we've worked together in the past is really important. And then how do we use the sort of our future efforts to really try and make sure that we're supporting a stable, sustainable and more resilient New Zealand. So there we go. I hope that's given you a few thoughts to prompt a few questions. I think the foundations that we've laid over the last 12 months stand us in good stead. So Anna, I might hand back to you now for to see whether there are any questions.
Thank you so much, Vittoria. I'm sure there will be lots of questions, and what a wonderful start. Of course, we've got the Governor of the Reserve Bank coming up next, so it was a great lead into his presentation. Lots of interesting issues raised there. Any questions from the floor that we'd like to start with? I'm going to start with one in Vittoria that's slightly tangential from your presentation, but I saw it come through on Slido and I thought it was an interesting question. What's happening to remittances to the Pacific? Because I guess we focus very much on New Zealand, but I'm just curious what's happened to our Pacific neighbours.
Sure, tangential, but a very important one. So I guess the issue that really is occurring around the world at the moment is that financial crime has greatly increased, and we all know this. And we see the nature of cyber threats has elevated and really changed as well. So I guess the whole challenge with remittances worldwide is this crime element. So a lot of processes have been added, which I think have really restricted some of the flows and remittances to the Pacific Islands. We don't want that to be the case. So we're actually working, again, this is another great example of how do we share data and risk data so that we can make sure that we're safely supporting that remittance activity to the islands because we know it's important for them. So that's the position that we are in. We need to solve for it and really make sure we're playing our part. Yeah.
Thanks very much. And of course, it is an important issue because our friends around the world are suffering greatly from COVID, and particularly in developing countries, we might be concerned. We've all been pretty quick to grab vaccines and grab things for our rich countries, but I guess I feel pretty concerned when I look at my 21-year-old daughter in North Carolina who's likely to get a vaccine next month, whereas our friends in India who are working in the health sector are likely to be waiting a long time. And I guess in the Pacific Islands, we've got some similar differences in access to healthcare resources and other. Okay, let me turn to a question coming through, another question. Vittoria, if you were running the Reserve Bank, so take Adrian's place for a moment, what structural changes would you consider to improve the recovery while still managing risk of further shocks?
Yeah, so I'm sure you're going to ask Adrian the same question. What would he do if he was running ASB? I need to make sure I hang around for that answer, by the way, Adrian. I think, look, the way I want to answer that question is actually to think about how we work better together. And one of the real opportunities that's come up that we observed during these last 12 months is how do we get more data? How do we share more data? And how do we stitch our data together? Because the RB's sitting on a lot of, big macro data. We sit on a lot of sort of, if you call it the micro data. And I'm not sure that we're as joined up as we could be. And therefore, we might be missing some trends. We might be missing some opportunities to really understand the impact of either monetary policy settings or the way that we transmit that through the bank. So I know that there is an initiative at the Reserve Bank and some new team members who are going to be leading that efforts, and I think that's really important. That's sort of the first thing I would call out is how do we use our data, share our data more effectively and efficiently to for the good of the country. I think the second thing that I would say is that, you know, just staying on the topic of monetary policy for a moment, it's back to how do we make sure that, I use this word orderly, that we're making orderly changes and that we don't have these unintended consequences so that we're sort of firefighting all the time. So I think we need to be very careful in which tools are applied, when and how. That's sort of really a statement of the obvious, but what it takes is, again, a lot of engagement and sharing of information and data on what's happening to see how the country is responding. You know, I hope we don't need negative interest rates. I've been quite public about that, and Adrian and I have had some good conversations about that topic. But yeah, it's really important to continue to have robust debate. Those are the things I think are really, let's make it orderly, be careful about it, and let's use data in a better way to support the objectives.
Thanks. And as an economist who's lived quite a bit in Japan over recent years, negative interest rates are a pretty interesting thing to deal with. It turns quite a bit of our standard economic thinking on its head, and it's a bit difficult to grapple with. We end up advocating policies that we might not normally be thinking would be good policies. It was interesting too, you know, and it came through in your presentation. As a bank, you've got the chance to change some of your settings. The Reserve Bank, of course, is changing some of its policy settings. But I was really interested in your presentation to see how you're using this as an opportunity to promote other things that you think are important. And I think we've got those opportunities in a wider economy. For you, it was the emissions, and it was the housing and the infrastructure. So great. Okay, I'm going to move on to quite a specific question, Vittoria, please. Have you done any stress tests on what rate of interest will lead to potential defaults in mortgages?
Yeah, so stress testing. I mean, as you know, we run a lot of stress tests, and they're becoming increasingly complicated because what we tend to focus on now is interrelated component parts of a stress test rather than single dimension, because what we're seeing is when you test on a single dimension, it never results in sort of really catastrophic events. It's when you actually have multi-dimensional stress tests that you really get into problem zones, which really make you think about how would you solve for those. So at a total bank level, that's what we do. I think a different way of answering that question around interest rates, though, is that I'm sure everyone's familiar, we don't just lend at or test serviceability at the prevailing rate of interest, we add servicing buffers. So we will always be several hundred basis points well above the prevailing interest rate to make sure that that customers can service. That's part of our responsible lending criteria as well. So I think that's another important dynamic, if you like, in terms of thinking about interest rates and the impact on stress and serviceability and repayment.
What would be the other sort of key things that you'd look at along with the interest rates in Victoria? Is it sort of growth rates? What are the key things that you'd be focused on that will create stress for income?
Employment. That is the fundamental. If you were to pick one thing that matters, it's employment. And I think that really sort of underpins the comment I was trying to make earlier on about New Zealand's recovery. The way that we were able to hold on to jobs, the way that employers had the confidence to keep their people employed really, really made the difference. And so obviously when you're employed, your ability to borrow, I mean, that's the crucial thing. It's not actually the interest rates per se, it's employment. Yeah.
And we certainly have kept those employment rates pretty low. What's your view on the extent to which that's just driven by the current policy settings, and once those policy settings change, the subsidies and so on, do you have a view on whether this is likely to blow out the unemployment numbers, or do you think that we're going to be able to keep a fairly stable path? I guess it gets back to your issue of what shape recovery are we going to have?
Yes, so I do think, and we know that there are some businesses who are doing exceptionally well, in fact, better than before the pandemic started. There are some businesses that are doing very well. I think at a macro level, personally, we are expecting the unemployment levels to increase slightly, but not to a level that's dramatic, because we've seen there's a lot of resilience still to date. And we will continue to support those customers that absolutely need it the most. So I sort of come back to, we're not out of the woods yet. New Zealand still needs support, but at this stage, I think unemployment, we're not significantly concerned about unemployment levels either today or for the remainder of the year.
Yeah, thanks for that. We've got a couple of minutes left. Are there any questions from the floor? Otherwise, I'll return. We've got a very active online audience, so thanks very much to you guys that are online. Okay, let me go to another question from our online audience, please, Vittoria. How do you see banking changing with fintech new models, and how does that put support or risk of financial stability and economic growth? How do you see those factors playing in together, please?
I think that's one of the most exciting parts of the job, actually, which is all of the new models that are emerging in banking, and how do we really frankly, we just need to continue to up our game because there's so many different exciting options out there. The number one concern I have is regulatory arbitrage. We've observed this issue in many other major economies around the world, where the prevailing incumbents are absolutely regulated, and the new entrants are not. And so what happens is you get a lack of innovation occurring in the incumbent, and you have the new techs that often, frankly, particularly the larger ones, and I'm referring to big tech here, grab a significant chunk of the value. They don't pay the local taxes. They don't employ people in the local economies. And so we're starting to see, I guess, a real economic detriment from what is well intended to have lots of competition in the marketplace, which is a good thing, but it's not really helping the economy at an overall level. So I think that's probably the most important thing, a level playing field.
Difficult to create that, of course, with new industries, with regulators often playing catch up with what's going on in those industries. Just a couple of brief questions. We'll go over a minute or two just because we started a wee bit late on your session. You spoke of the increase in deposits. Is there any evidence that some of those might be coming from unspent government subsidies?
Yes, there is, definitely. Yep, that's the quick answer. The government, it's a combination of the two. I need to be clear, though. It's obviously there was monies that came in from the government subsidies, and there's been this reduction in spending. It's the two things that work together that have resulted in the higher balances.
Yeah, thanks for that brief and insightful answer. The last question for you, Vittoria, before we move on to our next presenter, and it's a nice lead into Adrian's presentation. How worried are you about the potential return of inflation?
That's a watch out. Again, this comes back to how do we try and move forward in an orderly way? How do we not have too many sort of knee-jerk reactions or lots of change happening all at once that might impact and create an unorderly shift? So I think we definitely need to keep a watch out on it.
Thanks so much for all of those insights and that wonderful presentation. We've certainly had some themes coming through there, including the need for order when there's changes in policy settings, so I guess you and your customers can adjust appropriately. Thanks so much. Wonderful presentation. Let's thank Vittoria, and we'll look forward to seeing you online.
Thanks so much.